One of the questions that many of my investors give me is, Jeff, you mean I can use my IRA money, my retirement account money to invest in real estate? The answer is yes. I've done it. I've had hundreds of my investors in my group do it. And I want to make sure that you get your answers to your questions asked, and what better person to have than one of the experts. And one of the experts is Ramez from the IRA Club. So welcome to the show.
Jeff, thank you. Ramez Fakhoury here with the IRA Club. I know you didn't want to say my last name because you said it was pretty tough, and I completely understand. We just had this conversation right before we jumped on board. But I do thank you for the introduction. Yes, that is what we're here to do. One of the things I do appreciate about you, Jeff, is you do take a great deal of time to educate your investors, and that's actually one of the foundations of IRA Club is education. So I do thank you for taking the time to educate your clients and investors and members on, I think, one of the most underutilized ways of investing, which is using a portion of your retirement funds in the alternative space. So thank you for having me on board. Did you just want me to go through it? Let's just jump on. Let's take it from there. Or did you want
to, sometimes I'll have people and they'll come to me and they'll say, hey, I want financial freedom, 7 to 10 years, what I'll need to do. And then we'll kind of make a plan, figure out kind of what their number is. And a lot of times they'll have 7 figures sitting in their retirement account, and they're 45, 50 years old. And they're like, well, I can't touch it for 10 years. And I said, well, look, did you ever know that you can use that to invest in other asset classes? And they're like, well, I didn't really know that. So, literally they go from, I've got to work for 15, 20 years to maybe I don't have to work anymore if I invest correctly. So that's why I wanted to get you on here to walk us through that process.
And absolutely. And I think it's important to understand the history of self-directing and how it all came about. But with that being said, I'm just going to, and if it's okay with you, I'm just going to jump right into it.
Yeah.
So we're going to talk about the power of a self-directed IRA. Can you see this, Jeff? Just want to make sure. There we go. And let's just start from the beginning. The power of a self-directed IRA. That's what we're here to discuss. Again, Jeff, thanks for having me, buddy. And to Jeff's point, right? This is one of the most underutilized things I just mentioned a split second ago, that most investors just don't realize that they have a portion of retirement funds. But before I get involved, honestly, I told Jeff this a split second ago. I'm boring, right? I'm an investor just like you. I learned this concept, believe it or not, when I was 28 years old from my wife, who actually still works for this company. She's the CEO and trust officer. But a quick overview about IRA Club. We have been here for 16 years. We're based out of Chicago, Illinois. We currently have 12,000 plus IRA Club members. We just passed the $1 billion mark. Super excited about that as more and more investors are getting wind of this. We have 35 full-time team members that actually work remote and here at the office. But our main focus here, and when you think of IRA Club, I want you to think of Fidelity, Vanguard, Schwab, TD Ameritrade, or one of the other classical brokerage firms. Well, you're going to ask me, what are the real differences, right? What is the difference between them and IRA Club? And it's all about one word, and I'm going to repeat this word over and over again to you, which is control, right? It's taking the control away from them, because the majority of investors or people who have 401ks, IRAs, 403bs, 457s, I'm gonna get into that a little bit later, have it with their current employer. So why am I bringing this to your attention? That's traditionally within stocks, bonds, mutual funds, and ETFs. So why is this so significant here at the IRA Club is we allow you not only to invest in the norm, but within alternatives, right? Outside of the norm of stocks, bonds, mutual funds, and ETFs. That's what makes us so unique and valuable within our industry, right? So with that being said, I think it's very important that people understand not only is it control, but it's what's going on today with your retirement account. So what if I told you currently there are 64 million IRA accounts across the country, of which only of the 64 million, 1.8 million have $1 million or more versus 60 million accounts have $1 million or less. Why am I bringing this again to your attention is or better yet, what I should be asking is, what are the 1.8 million doing right that the 60 million are doing wrong? And the answer is very simple: self-directing, right? They're taking full control of their retirement account, because ultimately you cannot save your way to retirement. You have to invest your way to retirement. Now, the biggest issue is when you look at US wealth, the majority of that is held within retirement accounts. In fact, $34 trillion sits within retirement funds. The issue, what is the issue that you see here? The majority of that is between Gen X's and baby boomers, 25 and 53%. Millennials haven't even started. So there's going to be some real pressure added to the system, because we need to talk about how safe is your retirement account today. We know this: the stock market's unbelievably volatile. In fact, I think we're going to end just a little over 20% down for the year. Taxes are on the rise because of the Inflation Reduction Act. Congress has to come up with $4 trillion within the next 10 years. Think about this. Every single government program that we have, from Social Security, Medicare, and Medicaid, is really, really in financial stress. In fact, last year, Congress bailed us out with $2.2 trillion. We also know that less and less pensions are being offered because people are living a lot longer. The other thing that we need to take into consideration is inflation. I'm not into great detail about it, but I want you to understand, because it's, I know you don't have to be living underneath a rock to understand that it isn't going anywhere. Understand that inflation is here to stay. We have to get it back down to 2%. And I think that's going to take a little bit more time. And I think it's going to go well into 2023 and maybe even into 2024. But I want people and investors in particular, right, Jeff, and especially within your group or your tribe, to understand that before the 401k, before the 403b, before the TSP, right, before the HSA, it was the IRA. All retirement accounts stem from the IRA. So it was established back in 1974, really to offset the number of pensions that were being offered, right? The problem and the issue is, now we're looking at every single government program that they didn't take into consideration back then that's completely broken. The average American actually only has $40,000 within the retirement account. And I'm talking about all qualified retirement accounts. We know that $1,500 is what the average Social Security check is. Now, what most people don't know is Social Security, one of the first government programs launched in 1935, there were 24 workers for every one retiree. Today, that's 2 to 1. By 2030, because of medicine, that's going to be 1 to 1. Think about this. Back in 1935, the average American only lived until 56 if you were male, 58 if you were a woman. You never even qualified for Social Security. So think about that. Take that into consideration. Whereas 28% of Americans over the age of 60 don't even have a retirement account. Now, to add icing to the cake, we got to talk about the future. Now, I don't want to go into great detail about inflation. Everybody knows that it's hovering somewhere around 7.7%. Actually, I believe that number comes out today, if I'm not mistaken. But tax is the other thing that we're going to have to talk about, because as investors, understand that we're heading into a tax storm, right? Now, we all know that the highest tax bracket is the most impacted by this, because they're talking about raising that to 39.9%, please forgive me, and dropping it down from 540,000 to 400,000. But it's also, how does this relate towards retirement accounts? The highest businesses, and I'm talking about in particular in the S&P 500, that are making $1 billion or more in net profit, are now going to be taxed 15%. Now, where is this relevant again to your 401k? A lot of you get 3, 4, 5, 6% matches. They're talking about reducing those numbers by a percentage or two. Think about this. They're not going to take the hit. You're also going to share into that hit, and this is going to come out of your retirement. So the $1 million question that I'm going to ask you and all IRA club members currently here that ask me is, how do you get rid of Uncle Sam? And the answer is real simple. It's a gift. And Dennis Blitz, president of IRA Club, refers to it as a gift. I refer to it as the most underutilized way that we invest. I want you to think about this. It is really the ultra wealthy, traditionally, I'm sorry, people in the 32% tax bracket or higher that utilize self-directing. And that's really the accredited investor, right? But I'm also trying to teach this to everybody, not just the accredited investor, right? That the true focus, again, and I'm gonna sound like a broken record here, is control, because these are the real benefits behind self-directing. Okay, it's allowing you and giving you the flexibility and freedom to invest in what you want and know, all right, or what you know and understand best, all while growing your retirement tax deferred or tax free. But again, for me, and the focus is fee structures. Most people, I'm going to get into this a little bit later, don't understand fee structures. So I want to take a real case study, okay, that I see here on a day in, day out basis. If you want to maximize your growth, right? If you want to maximize your dollar, it's not just about you using your own personal funds. You have to utilize your retirement funds in the same manner. The problem is where your IRA or 401k or 403 may be currently held. Well, that isn't the case because it's tied in with the actual brokerage firm, and you're only allowed to go within those pool of investments. So why am I, again, bringing this to your attention? You need to grow your ROI 25 to 50% faster, especially if you're starting on later in life, with retirement funds. So I want to take a case study between personal funds versus tax deferred funds versus tax-free, in particular, the traditional and or the Roth. Now, again, I'm going to take a step back and I'm going to say I'm not going to go through all of the different types of retirement accounts, but the two most common are the traditional, the Roth. The only real differences are the contribution limits that I want you to understand, and when do you pay the taxes. For traditional, you take the tax deduction up front, and you will get hit on the taxes later on in life. In particular, it's called the RMD. That's at 72 years old. Next year, because of the Inflation Reduction Act, that actually is going to go up to 73. I think I'm sorry, I might have messed that up, Jeff. It's 72 this year. Next year, it actually goes up to 73. And in fact, by 2030, the RMD is going to get pushed out to 75. For those of you, just a fun fact. Versus the Roth IRA. You're not going to take the deduction. You are going to pay taxes up front, but for the rest of your life, you're basically watering the seed to the fruit of the tree, right? It's tax-free for the rest of your life and your heirs. So think about this. This gets passed along to your wife and also your kids. Keep that in mind, up to 10 years. So the case study that I want to bring in, this is an actual, forgive me, calculator that you could find in our resource center at the IRA Club's website, iraclub.com, or if you could also go to .org, where we're going to go tax versus deferred versus free. So let's just keep it real simple, right? I always say within one of the biggest powerful advantages within double-digit returns. You cannot rely on single-digit returns anymore. You can't have that mindset of set it and forget it. You have to be able to diversify. So if you were thinking about an annual rate of return, double digits of 10%, I'm being conservative. And if you wanted to do that for the next 10 years here at the IRA Club, and you were looking to invest $100,000, let's say you have $100,000 with Fidelity, Vanguard, and Schwab, you roll that over to us. This is what your payout will be after 10 years on the $100,000 when you use your personal funds, 302 versus deferred. So it's almost an extra 50,000 plus versus tax-free, 401. So you're talking about an extra $100,000 to your pocket. So keep that in mind when you're thinking about investing in, within retirement funds. It's much more powerful. You grow your ROI 25 to 50% faster, depending on how much you're investing and the longevity of the investment. But the problem is most Americans are not in the driver's seat. In fact, 97% of Americans hold their retirement funds within three places. I'm talking about $33 trillion. Bank CDs, annuities, and obviously the stock market. Now, I'm not going to get into bank CDs and annuities only for the simple fact it's less than 2% of retirement funds, and annuities, it's less than 5%. So the majority of that 97%, 90% of it is within the stock market. And in particular, The Fidelities, Vanguard, Schwabs, and TDs of the world, right? These are the four companies that really control the majority of the 33 trillion. In fact, they control just under 70% of those funds. So Fidelity was the first to capitalize on this. Most people don't know this. Within retirement funds and retirement accounts, they control 33 1/3% of that, established by the Johnson family back in they were the first again to capitalize in 1776 by introducing the 401k, followed by Fidelity, Vanguard, and Schwab. Now, when I talk about 8% returns, I am including 2021 into this, all right? So if you take the past 10 years, let's say that's hovering around 8%, but I think this number is very flawed. Why is that? Because our government printed $13 trillion into the economy last year and the year prior to that. So we're basically back to square one. In fact, we're going to be down this year. So everything that you possibly made is you're basically either breaking out even this year or you're going to be down 8 to 9%. The truth behind employer plans, okay? They're designed to always understand this. They're always designed to benefit you, not them. They're in control. As long as you work for your employer, they're in control of your 401k, 403b, 457, or TSP, right? They do this by creating artificial restrictions. I'm going to get into that a little bit later, but because they create these artificial restrictions, and you may ask me, what is an example of an artificial restriction? Hypothetical. You may have your next door neighbor's got a house for sale, right? And you want to use your IRA or 401k to buy that property with your retirement funds. And you were to say, walk up to your fiduciary or broker or registered investment advisor and say that I would like to utilize a portion of my retirement funds to buy that piece of property, generate passive income, rental income back to your IRA or 401k. The answer is going to be, oh no, you can't do that. That's what they say to you. But how do they counter it? Here are these other investments that you could look into within our portfolio. And if you're interested in real estate, they traditionally kind of throw you into a REIT. But my personal opinion behind REITs is they're giving you between 3 to 5% returns on investment. I think you're better than that. All while who's taking the risk? You. Jeff, you know that better than anybody. You wanted to jump on that. I saw that smile, that grin across your face. It's you. Again, the only time that you make money, understand this, is when the market is up. If the market, Jeff, you could answer this. If the market is down, do you make money? Obviously not. But do they make money?
Yep, it's a good business model.
Fantastic business model. But here's another slap in the face. What about if the market's flat? Do you make money? Obviously not. But do they make money? Yes. Why am I bringing this to your attention? We're going through it right now, okay? The market's got a pattern. Traditionally, it's about 8 to 12 years. This is the longest in U.S. history at a 14-year bull market ride. This will probably never happen again in our lifetime. It was fantastic. And people need to understand, I don't have anything against the stock market. I like the stock market when it's working in your favor. Remember, this is a game of Monopoly, and you got to know how to play the pieces on the board. This is just me saying out loud. We've had 12 recessions. I'm not going to go through all of them since 1952, but these are the ones probably within our lifetime that are probably more relevant to you. I'm not going to go through all of them, but I'm pretty sure we all remember the dot-com or the tech bubble, the Great Recession. So why am I bringing these to your attention is if you had hypothetical, if you were between the ages of 50 and 60, and I feel really bad for you right now if you are between those ages, and you're thinking about retirement, and let's just say you had $500,000 and you lost 100 or 200 or 300,000. And in particular, we're talking about the Great Recession. Well, guess what? If you were thinking about retiring at 60, that no longer is the case. You're going to add 4.3 years just to get back to that break-even mark. And if you were unfortunately part of both of these, well, guess what? You're not retiring at 60. You're retiring probably around 66 to 67 to 68 years old. The point that I'm trying to make is diversification, all right? You can't rely your 401k, your retirement plan just solely within the stock market. You have to look at alternatives at the end of the day. Otherwise, you're going to be working forever, which brings me into the concerns that we face here at the IRA Club. And Jeff, I'm pretty sure you went through some of these. It's lack of knowledge. People cannot identify investment opportunities. So that is the reasons why they don't self-direct. Think about this. Why would you ever roll over $100,000 over to IRA Club? Because that is the one thing that I can't do for you here at the IRA Club is I can't choose the investment. I'm giving you the control to do what you want for a fraction of the cost, which I'm getting ahead of myself. The other one that I hear that makes me laugh all the time. Am I too old to get started? When are you ever too old to get to basically tell Uncle Sam, kick rocks? Remember, the average American lives until, and Jeff, you're the doctor, correct me if I'm wrong, is it 78, 79, 80? Where are we at right now these days?
Pretty close, 77 to 78.
So if you're thinking about retiring at 60, and the average American actually, believe it or not, retires at 65, you still got about another good 15 years. Why would you not take the tax-deferred or tax-free growth? You're never too old to get started. Risk. I hear this all the time. Oh my God, is this too risky? Okay, or I like this one better. My fiduciary, financial broker, registered investment advisor said, don't do self-directing. I don't have anything against financial advisors, fiduciaries at all. In fact, we have 1,000 registered investment advisors that utilize IRA Club because they're listening to their investors, okay? They're telling them, I don't want my money in the stock market, right? At least for right now, I don't want my money in the stock market. I want to look at alternatives, and you don't have anything that I like. I found this investment opportunity. Let's just say with Doc right here. Doc, Jeff, you might have an investment opportunity, or next door neighbor, whatever the case may be, because I can't choose it for you. That is your job to find it. And be careful when you hear this word from your fiduciary or brokerage firm. You could self-direct with us. That is not true. It is not true self-direction. You're still tied into those pool of investments. I'm starting to see Fidelity, Vanguard, Schwab, and 10,000 of these other brokerage firms saying, well, you don't have to go to a self-directed IRA company like IRA Club because you could self-direct with us. That is not true. And lastly, the fiduciaries, brokers, and registered investment advisors, as much as I do like them, and I hope they're working out in your best interest, some of them don't even realize that this is an option. Believe it or not, 50% of them do not even know that this is an option again. So, and the other 50%, remember, their job solely is to keep the money within the brokerage firm because let's be honest, they need to make a living, all right? And it's much easier to hide hidden fees. Okay, this could be your best friend, and he could say to you, I'm not charging you anything, or I'm giving you 25 basis points or 50 basis points, right? Still, there are fees incorporated with these contracts within the brokerage firm. In fact, 62% of Americans don't even realize that there are hidden fees. 18% of Americans actually know how to calculate them. And of those 18% that do know how to calculate them, these are the ones that we educate our investors here at the IRA Club to look for. Okay, I understand it's a 200-page contract. They do that for a reason. They're trying to hide those fees within the contract. I want you to find them because they traditionally tack up to be between 2 to 4%. If you have management fees, and I'm talking about in particular, if it's with your current employer, there are management fees that are incorporated with it, and there's nothing that you could do about it as long as you're with your current employer. Why is this significant for somebody that is an IRA Club member? Because our business model here at the IRA Club is a flat fee model. We don't make money on percentages. I don't care if you have 10,000, 100,000, or 10 million. It is $175 for your IRA account to be your HSA account. Your solo 401k is a little bit more because of the structure. It's $365. But in particular, because we are talking about IRAs, okay, I don't care what you have in there. Our job is to make sure for us as the full administrator to cross all the T's, dot all the I's on your behalf as the investor to make sure you don't cause any prohibited transactions. All right. And it's 100. So and you're going to ask, well, Jeff, I hear this question all the time. How does IRA Club make its money then? It's a volume-based business. It's $135 per asset, per investment, right? So the IRA account's $175, and that's just flat. And then per investment that you do is $135. I just told you we have 12,500 IRA club members. We process about 400 to 500 alternatives a month. You guys could go ahead and do the math on that. It is in the millions. We don't make our money, again, on percentages. Why is this relevant to you, right? Again, same concept, $100,000. You roll that over to the IRA club. I want you to understand fee structures. This is on our website for the next 10 years. Same thing, 10% returns. And I just told you it's 175 plus the 135 asset fee. That's 0.3, $300, just a little over that. Versus the Fidelities, Vanguards, and Schwabs of the world, it's going to be between 2 and 4%. IRA Club is saving you just under $93,000 in fee structures alone. That is unbelievably beneficial to you. Now, don't forget, it's not just about the fee structure. It's also the benefit of you investing your retirement account to grow or maximize your wealth that much faster. So picture this. I just saved you $93,000 in fees, and then you grew your investment by an extra $100,000 or an extra $50,000 if you use tax-free or tax-deferred funds. That's what accredited investors do, or the ultra wealthy do. They find out all different strategies, just like this one, to get rid of Uncle Sam. With that being said, sorry, I'm just going to jump into it. And I always ask, discovering investment opportunities. This is a question because I can't choose the investment, right? In fact, our disclaimer simply states, we do these webinars, including with Jeff, for educational purposes only, right? We're here to open up doors and opportunities, all right? It's your job to do your due diligence, right? To do the background checks on the companies, right? To reach out to your CPA, your lawyer, or whoever your financial professional is, right? But I want to end with this note, Jeff. What is your number? Okay, this is very important. What is your number? What do you need to retire comfortably? And if you're far off of this mark, you need to get on the ball ASAP, because the average monthly expense as of November 8th is just under $5,600. That is almost $67,000 per year, up from $61,000 just a year ago.
Can I say something to this?
Please, absolutely.
Most of and this is one of the questions that I ask new Passive Investor Circle members, what's your number? What are your household expenses? What are you trying to replace with passive income? And I would say the majority, it's about double this. They're around $10,000 to $12,000, just kind of so we know what we're thinking about. Jeff,
this is me speaking freely. Okay. I am an investor. I am a partner at IRA Club. I am, to your point, me personally, I'm just talking about me. I can't live off of $5,600. Okay. I mean, my kids' childcare is $3,000 a month. Okay. Let's be real. So, I mean, this is just the average American, and I'm being conservative. I always like to talk conservatively, but just assuming you have no debt, right? Your household income, your kids are all, married, off to school. The average American, even at 65 years old, right, and retired, this is the point, is still needing $50,000 per year to live. So here's the point that I'm trying to make, okay? This is what you actually need to be invested, whether it's your personal funds or retirement funds collectively, in order for you to live whatever lifestyle that you're currently at right now. So at $250,000, just go through it. It's $10,000, right? Versus $2 million, it's going to bring you $80,000 a year, versus $2.5 million, it's going to bring you $100,000. This is what you need to be invested to get these returns passively, to create your own pension if you don't have one. And even then, sometimes your pension is just not enough. So I want you to keep that in mind. So if you're far off any of these, wherever you think you want to be, you need to get on this ASAP. Now, this is before taxes. Imagine if you used retirement funds, even if it's $250,000 or $500,000, that $20,000 per year is tax free. or this is all tax-free as a whole. So keep this in mind when you're looking into investing, because the facts of life are what you made this year. So for example, if you retired in 2020 and it was at 50,000, well, guess what? That isn't the same within the next 20 years. It almost doubles, right? It goes to 90,000. So keep that in mind when you think about investing. You need to be able to create, again, double-digit returns, because you're not going to make that in the stock market. Let's be honest with each other. Your 401k is not going to, historically, that doesn't happen. You need to look into alternatives, and you need to create double digits. Otherwise, you're going to work forever. Sorry if I sound like a broken record. So for those of you, I'd like for you to pull out your phone at this time and you just want to learn more about self-directing, right? Or if you want to contact me, this is all my contact information. This is direct access to me. You could share contact information with me. We always send, again, we can never choose investments. We can't talk about investments. If you want to learn about educational pieces, just like one of the things that, again, I love about Dr. Jeff is his website is pure education. And by the way, Jeff, kudos to you, because I love that. And that's what we have at the IRA Club, hundreds and hundreds of hours of content for you to learn about this new investment, a way of investing, better yet. So you could directly go to our website. You could actually, if you want to start an account, you could start an account. You could look at our reviews, my LinkedIn, my email address, all of it. But I think what you guys are more concerned is, what does the process look like? Okay. So with that being said, it's real simple. Remember, IRA Club's a full administrator. It's open, fund, invest. It's literally a 3-step process, except IRA Club is going to handle 1 and 2 for you. It takes literally minutes to open up an IRA account. I'm going to go through that in a split second. All you need is 3 things: your government issued ID, which I'm actually just pulled out right now for this podcast purpose. You need to name a beneficiary, and all I need is your social security number in order to establish an IRA account. 2, how do you fund your IRA, your solo 401k? The easiest way is a contribution, right? If it's an IRA, it's $6,000. If you're over the age of 50, it's $7,000. That actually goes up next year to 65 and 75. If it's a solo 401k, it's 21. And that actually goes up 2,000 to 23 next year. All right. Or if you have an old employer's plan. So if you just currently left your 401k, I'm sorry, your job, and you have an old employer's 401k or 403b, whatever it is, then you could go ahead and roll that over to the IRA Club. All right. If you're currently employed, unfortunately, you can't. But if you are over the age of 59 and a half, it might be a great idea to go ask your HR department. All right. Can I roll over at least my contributions? And I will tell you, 50% of the time, they will allow you to do that. So if you have the availability just to at least get your contribution limits out of there to the IRA Club, and you're thinking about investing in the alternative space or whatever it is that you like, that might be an option for you. And IRA to IRA transfers are honestly the second most common. All right. And again, IRA Club does all of the work on your behalf as far as opening and funding. The only thing that I can't do for you is investing. That is your job and solely your job for a fraction of what it costs. But if you're going to ask me, and Jeff, do we have enough time to show people how to go ahead and establish your account? Because IRA Club actually did create a landing page for your investors in your group or your tribe. So simply pull out your phone, scan the QR code. It's going to take you to this landing page. Okay. Here's Doc's logo, benefits of self-directing, how it works, a resource center. You could actually watch this video and it shows you how to open up your account. You could directly contact IRA Club. You could schedule a call with any IRA Club representative, including myself. And you could directly reach out to Doc Jeff. And then if you want to go ahead and get started, simply click on that link. And for those of you that are not familiar with Persona, please forgive me. We have to validate who you say you are. The way you do that is through a driver's license, state ID, or passport. Because I can't click on this because I'm using my camera, I'm going to go ahead and use my phone. Why is this important, you may ask? Okay, is real simple. Your IRA, your 401k, they are federal products. You're going to receive a secured link. I'm going to go ahead and click onto that. And I'm going to click on driver's license, and I'm going to click on the camera, and it'll auto capture it. Sorry, I'm going to move away from the light. Use this photo. It's going to scan my driver's license. And again, as I just stated, your IRA, your 401ks are federal products, which means you can't have any federal indictments against you. Otherwise, you cannot open up an IRA or solo 401k to invest in alternatives. So it's still scanning, and there we go. Start your application. To start your application literally takes less than 5 minutes. Choose the type of retirement account you would like to roll over. If you're not sure, please feel free to reach out to IRA Club. We're more than happy to walk you through this process. Let's just say traditional and just go through the entire process. It literally takes minutes. Now, I want to practice what I preach. And if that's okay with you, Doc, I want to offer all your members a free self-directed IRA account their first year, if that's okay with you.
Absolutely.
And the way that you do that is by using the promo code debt-free. That's it. So either mention this webinar or podcast, please forgive me. Say debt-free. I listened to you speak. And if you just wanted also to learn more about what is the process like, what is self-directed IRA is all about. It's a lot of information I probably threw at you. Do your due diligence. You could go through our website at iraclub.com, go to the resource center, right? We also have for any member for you, Doc, that is a part of your tribe, a free course curriculum that actually will go through the whole process of what is a self-directed IRA, what is a Roth, what is a backdoor Roth, what are prohibited transactions, what does the process look like, okay? And it comes with a free self-directed IRA account. So, and Dennis, president of IRA Club's latest book 8 months ago, how to make money with your IRA and 401k. He is the author of 17 books, very well respected in our industry. So that's also included. Jeff, I hope this was very educational, beneficial to all of your members and tribe members. Is there any general questions, Jeff, that you think that they may want to ask or we could go over or talk about?
I think you've covered everything except, are there any, I know you've discussed most of the pros, but I always like to see, are there any cons to investing in a self-directed account?
So it comes down to, when you think of cons, a lot of people, when they talk about risk factor, right? A lot of people that when they look at alternatives, one of the okay, I don't want to say it's a mindset, but one of the negative features that we get is there's a lot of fraud out in the alternative space. Mm-hmm. So you want to go ahead and be able to do your due diligence and do background checks. You want to make sure that all of these people have skin in the game. And my personal opinion is, listen to your gut, listen to your heart. If something doesn't make sense to you, don't do it. All right. As far as self-directing, some of the other negatives that I see is if somebody has a checkbook LLC or a QRP, which is also known as a fancy marketing term for a solo 401k. Understand we see this on a day in, day out basis. There's a lot of prohibited transactions that happen. True story. I would say about 80% of people who utilize these two. By the way, I should backtrack, Jeff, and say this. We have those options for you. We have checkbook LLCs. We have QRPs and solo 401ks. Now, keep in mind, they cost more money. And does IRA Club want to make more money? Absolutely. But I will tell you, the only time that you should ever think about doing a checkbook LLC or a solo 401k is if you're doing tax liens, you're at the auction trying to buy houses, or you're doing fix and flips that you need access to the money right away. Other than that, let IRA Club do its job for you. That's why we're the administrator. Again, and I could typically know that, Jeff, within 5 or 10 minutes of talking to somebody, if they understand the rules and regulations within self-directing. And that is one of the negative downsides to self-directing, is the rules change quite often, right? And you know that, and most people don't know that. And our job is to protect you. The other thing that I want you to be weary of is with the Inflation Reduction Act. We all know this, that they promise that they're not going to be raising taxes on the middle to lower class, right? But what are they doing? And you know this, and you're smiling because they hired 87,000 IRS agents to go after the middle class. Now, why is this relevant to retirement accounts? Is I just brought up the checkbook LLC and the solo 401k. Why am I bringing this up again? Is that's what the IRS is looking at, right? Are LLCs and 401ks. Most investors do not know this. The IRS does not have an audits division for IRAs, but they do for everything else retirement related. So as the administrator, we've never been audited for 15 years because once they look at that, they just think it's a waste of time. Again, it's risk. It's taking educated, calculated risks. That's one of the downsides to self-directing.
Okay, excellent. But I'll number one, I appreciate your time. Very good explanation. And for people that want to learn more, I'll make sure I'll put those links below this video. And then if they want to reach out to you directly, how do they do that?
So there's one of two ways. You go to iraclub.com. I did also, by the way, put out my personal contact information through that QR code.
Okay.
This is literally everything across the board. But if you go to iraclub.com, you go to the top right side, you could schedule a call or contact us forms. They're all right there. Again, my recommendation is educate yourself first. You're going to have a lot of questions. Write them down. Reach out to us, and let's just take it from there. Let's find out. Remember, everyone, you know this, Jeff, everyone's goals and situations are different from the next. So my piece of advice is to do the background checks, learn about this. Let's put you in the right type of retirement account. It's for free your first year. All you got to go do is find the investment opportunity.
Excellent. Thanks again. And as these things change and progress or update information, we'll certainly reach out to you to update this information if you're okay with that.
Absolutely. Absolutely.
Perfect.